Okay, well, welcome everybody. It's great to see you all, and thanks to those joining at unsociable times of the day and night, particularly not good for North America at the moment. Couple of welcomes to new faces on the call. I'm just trying to see if yeah, so we've got Nigel Jones, who's joined the team at CIPFA. So welcome, Nigel, and you're presenting on foreign exchange later.
Thanks.
And a sort of what you might call an old face, but also a new face to some of you, Easton Billsborough, who's standing in terms of the ISB input. Welcome, Easton. Also very nice to have you, bearing in mind Easton actually did a lot of the forerunner work before we set up IFR for NPOs, and then moved to the FRC just at the point in time that we got the funding, and was working with Jenny there, and then has been working with the ISB on IFRS for SMEs, and in particular was a key author on the Section 23, IFRS 15. So brilliant to have you with us, Easton. So I think that's it in terms of new faces around. Anything else we should say at this stage? Karen, obviously we're going to do the usual thing, which is we'll move through the agenda and then we'll take a 10-minute break at an appropriate point in time. I suspect that will probably be after we deal with revenue. But we'll see how we go on that.
Yeah. Just to say that Tim's unwell. He's got COVID for the third time and has sent through his apologies. Yeah. He's really sorry not to be joining us today.
Yeah, thanks for reminding me about that, Sam. And we send our best wishes to Tim. Really bad luck on that.
And just to mention that Chris Twagamara has left the institute in Rwanda, and we're currently talking to him about successor arrangements. So that's why he's not here today.
Right. Okay. So with that, we move into the first substantive item on the agenda, which is revenue. And Paul, I think without further ado, over to you. A lot to cover. I'm expecting we're going to have quite a good conversation about a number of items there, but I won't steal your thunder anymore. So over to you.
Thanks, Ian. Yeah, there's a lot of material to get through, so I'll try and be brief. So the first issues to discuss are around the structure of Section 23. We had the discussion the last meeting about what structure, whether we should go for a single, effectively a single section in the way that the IPSASB has combined the exchange and the non-exchange into one section, or whether we should retain the Section 23 from the IFRS for SMEs exposure draft and do a separate section for grants and donations. That was the favoured view at the TAG in last meeting, so that's the approach that we've taken. And based on that, we have those two sections. So the structure of our Section 23 now is the preface, which sets out the criteria for deciding where you go. We then have revenue from grants and donations as part one of Section 23, and revenue from contracts with customers, which is based on the IFRS from EASE exposure draft, as part two. So the first question is, are TAG members happy with that structure? And particularly that we include grants and donations before revenue from contracts with customers, given it's probably more significant for NPOs.
Okay, thanks, Paul. So open for comments on that. Yeah, Jenny, kick us off.
Thanks, Ian. I was just wondering, I don't know if I missed it, but presumably we're not going to have Section 24 on government grants, so that's is now sort of deleted because it's going to be incorporated here. Is that right?
That's correct. I mean, I think the principles of Section 24 are covered in the grants and donations chapter or part that we have, but there's a lot more detail, effectively taking a lot of the detail from Section 23.
Yeah, I mean, I thought overall having the two separate elements, I think, is the right approach, whether they're in separate sections or separate parts of the same section, but having those things together, having both bits, I thought was right.
Okay, thanks, Jenny. Freddie, to you.
Thanks, Ian. And I think I mentioned it the last time that we went down the different route, and I'm happy to be minority. We have a single model in the spirit of simplification, and also but I think the risk is that if there are slight differences between the two sections, even though they should result in the same outcome just between exchange and non-exchange, obviously there's obvious risks, but again, happy to be minority there. If it's split, then I agree that donations would come before the exchange transactions.
Okay, thanks, Freddie. Jeff, Ben?
Yeah, thanks, Ian, and good morning, everyone, or evening or afternoon or whatever time it is for you guys. I do like having two separate sections. I think you have rules of the road, and I think, as I mentioned the last time we met, that it would be less confusing, especially for auditors or others who might go back and forth between the two sectors, not to have a model for earned revenue that is different. But I have a couple of suggestions, I think, that might make this seem less redundant, or at least fit things together just that much more. First, I was struck by the really good flowcharts that are in Chapter 24A that aren't here. And I think that that might help a little bit in terms of navigating through each of the separate sections, especially the first section on grants and donations. The other thing that I think could be helpful here, I don't know if it's in the authoritative guidance or in the implementation guidance or whatever, would be a sort of side-by-side chart which compares the terminology. I mean, you have very, very similar models for binding agreements in the first part, and then for contractual agreements in the second part. Just a little side-by-side, just for this step we use compliance obligation. This step is performance obligation, and same step is performance obligation. So I think those two things, flow charts and sort of a side-by-side, at least terminology chart, or just comparing, contrasting the two somewhere, I think would really help a lot. And again, it would make it seem less redundant or otherwise just be much more navigable.
Thanks, Jeff. Yeah, I mean, I'm a great fan of having those sort of flow charts and so on, just to help orient people. And I think using some of them, the approach in the grant expenses seems to make sense. I mean, to an extent with this, whether it's parts or chapters is down to semantics. And I think, your point about the key thing is navigation, actually, is probably what we need to think about at the moment. And we'll have a discussion in a moment about duplication. Anybody else have any strong views at this stage? Okay. Well, I suggest we sort of move forward with the parts that we've got, but I think, if we agree that we need that those sorts of the flow chart and the let's have a look at how we make terminology differences and similarities clearer in moving forward, and that obviously will be done in parallel with the grant expenses chapter. Okay, Paul, move us on to the next questions.
Yeah, so the next question sort of follows on from this, which is, first of all, do TAG members have any thoughts on how we could address duplication, perhaps reduce it if possible? And then secondly, one thought is, given that the section now is about 280 paragraphs, it's much longer than anything else in INPAG. Our tag members content that we at least ask the question as to whether the sector is happy with that approach and keeping the earned revenue separate from the grants and donations, or whether they would actually prefer a single unified section.
Thanks, Paul. Comments on either of those questions? Yeah, Catherine.
I think my only concern with asking a question is more of a due process one, in that, is it going to back us into a corner if the approach that we've proposed in the ED is not what the feedback agrees with? And would that be a significant enough issue that would potentially result in needing to re-expose? So I just don't know if we want to ask a question that we may not like the answer to. So just something to consider, whether it actually might make sense to just do a little bit of groundwork now to make sure that that's the comfortable approach across the board, instead of asking that question at exposure when it would be too late and cause potential significant implications in the timeline.
Thanks, Catherine. I smile hearing you say that, because IPSASB, which put 2 exposure drafts into one for the final standard, is going to have exactly that debate in 10 days' time at its meeting, as to whether it firstly approves the unified standard and then whether it needs to re-expose it or not. And that would be one of the things to consider in that discussion. So I think it might be worth watching that space actually and seeing how that debate plays out. And there will be a paper on that posting, I think, later on today. Bill.
No, I completely agree with Catherine. I answered question 3 no, because I think for the same reasons. I think it just opens up a can of worms, and it might cause us to either re-expose or just completely redo. For example, when the lease accounting was not re-exposed after all the changes they made, dropping the changes in lessor accounting, I was surprised, but it worked. It seems to have worked. But I think that would just put us in a position of slowing down the whole process. So I prefer not to ask the question.
Thanks, Bill. Elaine.
Yeah, I was about to actually say the same thing like what Catherine has mentioned. I think my concern is whether if the feedback come back is not on what we propose, the issue of real exposure will definitely be raised. So just a bit of cautious there.
Okay. Any comments on the duplication question? Yeah, Bill.
I would only say that after all the concern about having too much duplication, I don't think it's that overwhelming. I actually, when I read through it, yes, I can see where there's some paragraphs that are duplicated, but it's really not extreme by any stretch of the imagination. And I thought it was very manageable. I thought, Paul, you did a pretty good job.
Thank you. Thanks, Bill. Okay. Well, I think, obviously, and going back to the previous point, I think navigation helps as well in terms of managing the length from a stakeholder point of view. I think a clear steer from the tag not to ask a specific question on 1 versus 2 parts or chapters. Easton.
I just had one point on navigation. One thing we're hearing through the feedback on the IFRS for SMEs exposure draft is the inclusion of having those steps in order has been really helpful. And I noticed in part 1, there aren't any explicit headings of steps. I didn't know if that was deliberate, but it might help with navigation and also help people make the link between both part 1 and part 2.
Thanks, Easton. I think that's useful, and clearly it'd be very useful to see once you actually get into the analysis of the feedback, what's coming through on that.
If I can come in on that, Ian, I have added implementation guidance, which compares the different the 5 steps in part 2 with the same sections in part 1. The issue is that the first step isn't quite in this, is slightly different in that in part one, you're actually deciding if there is a contract or a binding arrangement, rather than saying which one is it. You've got the choice, well, is there one or not? So it appears slightly earlier and isn't technically a step for once you've decided there is a binding arrangement, but there is a table in the implementation guidance which effectively maps the steps to the equivalent paragraphs and sections in part one. So that might be helpful.
Okay, thanks all for that. Welcome, Anthony. So I think that's been useful anyway in terms of that sense on duplication and not asking SMC. So then move us on to the next question, Paul. Next question.
Okay. Yeah, the next question is around the preface. So deciding whether you're going to follow part one or part two. Key guidance is in paragraph 3.2 of the paper, and just seeking members' views on whether that's appropriate.
Thanks, Paul. And obviously the same comment applies in terms of navigation and supporting aids. Jeff, you were first and then Beeling.
Okay. My only comment there, again, I like having it, and I think it is important to have that, what I'll call step 0 or whatever, there in terms of deciding what you're in. The only thing I might at least suggest is that besides the examples of in both directions where you have nominal consideration or and so on, is and I don't know how common this is internationally, but transactions that you might argue have significant consideration, but also significant donative elements. Would there be situations where you might bifurcate? I mean, you give an example in the illustrative guidance that has, I suppose, 2 separate transactions with the same party. I don't know if you have situations where you have effectively one transaction that has, as I said, both elements in it, and you might need to bifurcate. That may be something more we see here in the US, I don't know.
Okay, thanks, Jeff. So I'll take comments from Beeling and Catherine and then go back to you, Paul, if that's okay. So Beeling, to you.
Thank you, Ian. I don't have particular comment on the text, but I'm just wondering whether is there somewhere we can actually put in a decision tree that would be easier. I mean, normally decision tree, I think will make it much clearer than 1,000 words.
Thanks, Beeling. I think probably, there's room to experiment with, various different types of navigation. So probably that's the ask there, just to have a go at that. Catherine, to you.
My reaction to the preface wording was that it feels a little bit rules-based, and that we're quite specific in terms of, and it's a little bit to Jeff's comment as well, in that sort of we cover these 2 scenarios, but there's, I think, a middle ground that we're missing a little bit. So I wonder if there's a way to kind of make it a little bit less specific, so that we don't need to sort of cover all the different types of iterations that there could be in these types of transactions. I'm mindful, I think I had made this comment last time in relation to something else, but for example, we don't actually cover that there might be extinguishment of a liability. We're sort of only talking about exchanges of assets. So there's one example of something that may not be caught by the way that we've drafted this. My reaction, and I'd be happy to share some of our Canadian language, is that we might want to take it a step back and kind of talk a little bit about the idea of a non-reciprocal transaction versus specifically saying if you exchange things versus if you don't. And the concept that often in these transactions that the benefit or what's being exchanged is actually going to a third party or a group of third parties, as opposed to the person who provided the grant. And I think that's a bit of a concept that maybe I'm not seeing in here. So I just maybe try to pull it back a little bit and maybe have higher level concepts as opposed to trying to get into the specific types of transactions.
Okay, thanks, Catherine, and certainly sharing some drafting would be helpful. Paul, anything you want to say before I go to Freddie?
I think the intention is that we are sort of looking at, whether you are providing to, the intention is if you are providing to the, effectively the purchaser, then you're in part 2. And if you're providing to a beneficiary, it's part 1. But if the wording's not as clear as it could be on that, then we'll look at redrafting.
Okay, thanks, Paul. Freddie, to you.
Thanks, Ian and Paul. And yeah, just picking up on comments from Catherine and I think Jeff, we were at some point going down reciprocal and non-reciprocal, and I think nominal would be somewhere there as well. And after all that, a few years back, we landed on at consideration, I think the words significantly lower than fair value, which I think could address the rule-based wording, as well as I think nominal can be quite open for interpretation or not. Actually, not sure what nominal is, and I'm not going to the low value of leases thresholds in the leasing standard BC. So just keep it there.
Okay, thanks, Freddie. Any other comments then before we move on? Okay, so move us on then, Paul.
So next thing we're looking at is part 1, which is effectively taken from, in the most part, the IPSAS work, obviously with a number of changes, such as taking out references to goods or services being returned to the purchaser. So given that we've got some separate sections in for where you've only got one compliance obligation, we've put simplified processes in as the board asked. Then I think we're just asking, first of all, are TAG members happy with the approach that we've taken to get to this part of this to part 1, and are they happy with the proposed structure?
Okay, thanks, Paul. Comments on either of those points?
Can I just say, Ian, I think Paul did a magnificent job in trying to merge kind of the IPSASB approach and language with the Section 23 steps and trying to meld them together. And Paul, you in your introduction, we talked about the IPSASB, but it's also trying to lay it out in a similar way to Section 23. So there's quite a lot of thinking that Paul had to do to try and get it into that kind of shape. But just to emphasize that was the approach, was to bring both of them together to create the sections for grants and donations.
Yeah, and if people think some of the paragraphs are in the wrong place, or a slightly different flow would work better, please let me know, because yeah, I haven't had enough time to sort of go through and reread it a few times just to make sure it all flows properly.
Thanks, Paul. And I think also bearing in mind the comments about flow charts and, and something that will help as well as you kind of walk through that process in terms of determining what the right positioning is and so on. Okay, so I've got some hands up. So Freddie, to you, and then Jenny, Jeff, and Lebo.
Thanks. I think in terms of approach, one question I had in mind was, if we are picking IPSASB approach as we are, however, our concepts were picked up from IFRS for SMEs, I'm not sure how much they needed alteration, if at all, to enable IPSAS. And that's Ian, I'm not that close anymore or yet to IPSASB project, whether you needed to go and do some tweaking in the conceptual framework, especially around the compliance obligation resulting in a liability. And I did went back to, I think, the ED1, and I haven't seen any specific amendments to IFRS SMEs concept in that respect, but not sure whether it was required. in this area. So that was one question that came to my mind.
So, I mean, just on the whether IPSASB did anything, I mean, we are in the final stages of some limited updates on our elements chapter in our conceptual framework, but actually what we've done there is to bring it closer to the updated ISB framework, and in particular the concept that you can have more than one past event, you know, that would give rise to a present obligation, and that helps you certainly in terms of you know, where you've got capital grants and stuff like that. So we have done some tweaks, not wholesale changes, but we work quite hard to make sure that we've got compliance obligations fitting with legal and non-legally binding and those sorts of concepts. Paul, I might go to you just in terms of then sort of fit with, you know, section 23, and obviously referencing back to the conceptual material earlier in impact.
Yeah, no, I don't think we actually need to make any changes there, because both section 23, the revised section 23 in IFRS for SMEs, and the draft IPSAS were both very heavily drawing on IFRS 15, same concepts. And I think that the conceptual changes which have been made in the IPSAS sort of do bring it back in the framework, bring it closer to IFRS. And I think the one that was most relevant for revenue and transfer expenses, grant expenses, is that sort of more emphasis in resources on rights rather than anything else. And I think that does tie into things like the compliance obligation and the equivalent terms in grant expenses. That greater emphasis on rights as resources, I think, sort of covers everything that's needed.
Thanks, Paul. So Jenny, to you next.
Thanks, Ian. Yeah, I was just going to ask about the fact, so the section is covering grants and donations, including in kind as well as sort of cash or asset donations. But then we were just using the term a binding grant agreement, and I wondered whether that was going to be helpful for people, because it sort of sounds like we've then narrowed it down to grants, where actually it is covering a wider range of things. And I don't know whether other things were thought about. The problem is you can sometimes get into a rather long phrase, but I just wondered if that was sort of would convey to people that it was the wider range of potential resources. Thanks.
Paul, back to you on that.
Yeah, I mean, we do have a paragraph in guidance which says we're talking about grants, but it covers grants and donations and anything else, any other similar types of transactions. So we've got that in the guidance. So hopefully that will help. I mean, we can perhaps tweak the definition of binding grant arrangement to emphasize that this covers any agreement where there is it isn't just grants. It does cover other forms of donation where you've got that two-way obligations. So we could perhaps just add some additional guidance into the definition to emphasize that it's not limited to grants per se, but it's anything that has that same form of donation.
Or could we call it like grant or binding grant or donation agreement or something? I don't know if we can get it into the short form phrase. Maybe that's too difficult.
I think the problem is we then later on move on to the binding grant arrangement assets and binding grant arrangement liabilities and start getting those exceptionally. Yeah, I mean, they're already probably longer than I would like. But,
yeah. Okay. Yeah. Thank you.
Just stepping back to binding arrangement, but no, let's not go there.
Trying to avoid using the IPSASB term when we've got a slightly different meaning.
Jeff G.
Thanks. I just had a quick comment. I think it's something that we'll touch on later, so I don't want to spend too much time on it. But I think in some of the sections, there was a section I think in where they talked about no restrictions versus there's no binding grant arrangement. I think I could send some drafting comments over after, but I thought that sometimes restrictions and binding grant arrangement might be used interchangeably, and I just wanted to, I will send some stuff over as part of maybe drafting comments before you send it out, just to, because or maybe they're questions and maybe I'm incorrect. So I just wanted to just point that out. And I think we're going to be talking a little bit about that later in a later question, so I won't say any more.
Okay, thanks, Jeff.
Yeah. Thanks. That would be helpful. And we did go back and forward on exactly where that boundary between what's a binding arrangement and what isn't a few times. Right. So yeah, it's quite possible some of the drafting sort of changes have not always been picked up.
Okay, thanks for that. So Lobo and then Beeline.
Thanks, Ian. So I just wanted to, so from my perspective, in principle, really happy with the approach that's been taken. What I did want to highlight, kind of stemming from the conversations that I've been involved in over the last couple of weeks on the IFRS for SMEs, was that the 5-step model was not well received in this part of the world. So I just want to reiterate Jeff's call for some form of, guides, flowcharts to help this process, because a lot of the people have said it's just too complicated. It's not necessary in the IFRS for SMEs. So I just thought it's worth pointing that out. Thanks.
Yeah, thanks, Lobo. Yeah, I think the more we listen to what's being said and where the particular problems are arising, that's really important. Elaine.
Thank you, Ian. I'm just wondering, because we are now at the tail end of the ED1 exposure draft on the IFRS for SME, and since we are also, using some of the wordings from this proposed section 23 of the IFRS for SME ED, my question is really to Easton and perhaps Jenshell, whether so far anything that we have heard so far on section 23 that people have expressed concern, because this can be a lesson for us, in drafting the section that we are looking at. No commitment, just what you have heard.
Yeah, thanks, Beeling. And I guess also, am I right in understanding that PIR is upcoming on IFRS 15 anyway? Perhaps Jenshell or Easton, you want to come in response to Beeling's point?
Easton, would you like to speak first? Yeah, and then I can add some additional comments. Easton, please. Yeah.
Thanks, Jenshell. So in terms of the feedback that we've heard, and I appreciate this maybe doesn't chime with the views just expressed from those speaking with PAFA, is the 5-step model has been seen as a good structure for people to use. It gives them a sequence to think around revenue transaction, although that isn't maybe necessary for the more complex ones. That's not necessary for the more simple ones, but for more complex transactions, people do find it a useful sequence to structure their thinking. And by structuring the section around that 5-step model rather than placing recognition and measurement at the start, that's been something that's been very, very well received. That was quite simple to do from a drafting perspective, but again, it seems to have been seen as a positive simplification that we've made. In terms of, it's quite hard to say what we have got without going into specific details of the standard in terms of feedback, but there seems to be an acceptance that the new model that we're moving into through IFRS 15 for SMEs is something that has been welcomed, because it puts revenue on the same place of maybe its listed peers in certain jurisdictions, and having that comparability is beneficial, not having two models, although in some instances they can get to very, very similar results, if not the same results. Having the same language and same concepts between, as we refer to it, the sort of big book, full IFRS, and the small one, IFRS for SMEs, has been positive. But Jenshell might want to add a bit more in terms of feedback, but also the PIR of IFRS 15.
Yeah, thank you, Easton. Yeah, first of all, because we're still waiting for the comment letters, at this stage. Normally, those comment letters will come out at the end of near to the deadline. So the deadline of the comment letter is I think 7 March. So we are still currently we receive some, but I think a larger numbers comment letter will come out the next 2 weeks. So so that is obviously we should, based on our feedback received from through comment letters. In terms of the feedback we received by now, obviously we conducted I think many outreach activities with different stakeholders and including national standards. So far, as Easton mentioned, that generally sounds like many stakeholders quite support the direction of the exposure draft, that section 23, to align with IFRS 15 with a lot of simplifications. So that is the general impression we got. Actually, to me, I also feel a little bit surprised when we conduct those outreach activities. Actually, there are no big question on this general direction. The issue came out mainly focus on some specific issues. For example, even yesterday I had a conversation with some Chinese stakeholders because Easton asked me to confirm some points they raised. For example, we simplify how to assess principal or agent, and actually some stakeholders would like to not think, they feel we simplify too far. Actually, they would like to bring those indicators included in the IFRS 15 wholly. So sounds like different people have different views on those proposals, but generally sounds like quite supportive to the direction. Obviously, we are aware introduce new model, that's 5-step model. Actually, will add complexity, but obviously, if SMEs only have those simple transactions, normally it's not necessary for them to go through very complex, process. If they do have complex transaction, maybe this model will help them to recognize and measure those revenues. So that is the general feedback we got, but obviously we are still waiting for the formal comment letters from stakeholders. Thank you.
Okay, thanks, Zhengxiang and Easton. And I think, obviously we want to see what comes out of that. It certainly seems to me that, for example, we have got the section on, sort of single compliance obligations later, so we need to sort of locate that in the model. And I wonder also whether this doesn't mean that, the selection of IG material and implementation examples probably also is really important, thinking about that feedback. And I think, Leibo, if there's any sort of specific things that were coming out other than people felt we don't like the new model, but if there are specific things that have come out, that would be really helpful to know that in terms of targeting both the navigation and the use of IGs and IEs, for example. Bileng.
Yeah, just a quick one to add to what Zhengxiang has said. I think so far I've also not heard about any contentious comment on Section 23 compared to Section 11 on financial instrument. I think the principal and agent came up, that issue. The other one, I guess, is not so much of the 5-step approach, is I think some concerns on the requirement to disclose unsatisfied promises in the exposure draft. Thought to share on that. Thank you.
Thanks, Bileng. Okay, so I think we note the caution and the fact that we need to keep an eye on the feedback, and I think we need to keep having a look at the IGs and IEs and say, do those actually give the context for non-profits, but also are they really addressing issues that people see and how you apply the 5 steps. Okay, so then move us on, Paul.
Thanks, Ian. So the first section of part 1 is dealing with transactions without restrictions, effectively without binding arrangements. And we will look at the wording around that to make sure we're consistent. So for this, you would be recognizing an expense either as you receive the grant or donation, or if it becomes a receivable beforehand at that point. And we've also included in this section specific provisions for gifts in kind and services in kind, with the some exemptions or some permissions not to fully recognize the assets as soon as you receive them. These have either been taken from IPSAS in terms of the not having to recognize all services in kind, or in the most part from national standards, which have been addressing these issues for non-profits. We did consult on these in the consultation paper, and there was general support for including these types of exemptions. So we've put specific guidance in for goods in kind, services in kind, which TAG asked us to do, and we've included the exemptions in there. So a number of questions. TAG members agree with the proposed accounting in general. Are they happy with those permitted exceptions? And do they agree that permitted exceptions should effectively only apply to revenue transactions where you don't have a binding arrangement? Because if you're doing, if you've entered into a transaction where you're going to do something for those goods or services, then when you recognize the liability to do them, you need to recognize an asset as well.
Thanks, Paul. Jeff, you want to come in?
Yeah, and just has to do with services in kind. And, you mentioned you look to national standards, and we took in US GAAP, we have a somewhat different cut, which has to do with measurability explicitly in terms of skilled services. I'm just curious, for those who have the would have had to purchase type of practical cut, which is what this takes from, how does that work in practice? I mean, is that ambiguous at all, or is it work well? It might get you to the same result. It's just, as they say, it's sort of a different way of going at it.
Thanks, Jeff. It's always a vexed question, that. Any sort of feedback from anybody else or comments from you, Paul? I mean, it certainly seems to me that if we go down this route, it's certainly something that we should be asking an SMC around, to elicit feedback on that for the reasons you articulate, Jeff. Catherine, to you?
Yeah, I guess a similar point. I am concerned about, I guess, measurability. I know that's a huge concern with our stakeholders in terms of particularly a lot of the different types of donated goods that can be received and may not necessarily be critical. We've taken the lens to kind of answer Jeff's question. We're actually in the process of revising our criteria for recognizing contributed materials and services. Both will apply the same guidance. And our stakeholders, we had a criteria around would have otherwise been purchased, but our stakeholders found that problematic. So we're actually going to be tweaking that a little bit and more focusing on that it's something critical to the mission or the objective of the organization, so that it's not that just they would have been purchased, but are needed to be purchased in order to receive or to execute their mandate. Excuse me. To make it a little bit more specific that only organizations that are getting critical materials and services will be recognizing those, and so not everyone who gets donated goods would have to go through the exercise to do that.
Thanks, Catherine. That's useful to know that. Bill?
Thank you. The first comment I had is terminology. I'm used to the concept of practical expedient, and that is used once here in the application guidance, but we used the concept of permitted exception. I understand it's virtually the same thing, but I wonder why we made that change, if that was intentional. We're avoiding the concept of practical expedient because that's what these are, all things being equal. So it was just that. And the other thing is, I had a long discussion yesterday with two members of the Mexican board, and wow, we used to have a standard very much aligned with FAS 116, US GAAP, where you did record services in kind. It's mostly, that's the problem, is it did not go well. It was very, very challenging. And we finally got to the point where the current Mexican standard does not allow the recognition of any services in kind. They find that's very challenging. It goes against the conceptual framework. You get nothing for nothing. For example, if very many of these organizations have the accounting services are donated or done very, very inexpensively. So what do you do with it? I mean, they didn't pay for it. And they never had, or they paid very little for it. And what are you supposed to do? Compare it to what you would have had to pay if you didn't have a member of your group, a church or any other organization. I've had a lot of groups, a lot of NGOs here in Mexico where they're let's say Christian based, and the accountant is a missionary who's funded by somebody in the US. They don't record anything in Mexico. They disclose that their accounting services are provided free, but the whole concept of recording that and valuation is very difficult. It did not go well in Mexico. And about 12 years ago, we switched from the US approach and the recognition of services in kind to just disclosing them and not recording them in any way, shape, or form under any circumstances. And part of it was because of what Jeff said about would have otherwise been purchased. We also found that to be very, very problematic. So we here in Mexico do not believe at this point in time. I tried to get them to switch over. I said, look, what is the problem here? Do I suggest that we modify the impact guide as it's proposed? Or do I go back and we need to modify Mexican GAAP? And I got such rebuttal. We're not going to change Mexican GAAP. They think it does not make any sense to record these things. So that was a very challenging item, but basically on services in kind. I have some other comments on the gifts in kind, but I think I'll wait and see if there's any reaction to what I just said. But the whole concept that, what's the difference between what would have to be purchased and what otherwise was purchased? I mean, you have to prepare financial statements. You have to prepare accounting records. And almost always those services are done at a very low or no cost because someone in the church, someone in the community donates those services. And if you didn't pay for them, why are you recording income and expense at the same amount? They find that makes little or no sense. And I raised the issue of comparability of two NGOs. One pays for it, one doesn't pay for it. They said, well, they couldn't find that I couldn't give them any arguments to support what is proposed in the current draft. So I just wanted to mention that. And like I said before, well, I can mention now the one gifts in kind in paragraph 2345, there's a mistake. It says under the permitted exception of the practical expedient, it says for items that are received, a low value, high volume, distributed to beneficiaries or consumed internally. It says you either don't recognize it or you wait, and at the time when it's distributed, you recognize an asset and expense. You meant to say revenue and expense. It is correct somewhere else, but in paragraph 2345 in B3, it says as an asset and expense, and that's not correct. It's revenue and expense. But and even on that, they were saying, let's say you have towels, let's say you have blankets, let's say you have soap, let's say you have toothpaste that's donated, a truckload comes in. I was the president of the board of World Vision Mexico, and we get trailers full of stuff, little stuff. That is all disclosed. It's not recorded. And this would propose that you have to record that. You don't have to record it when you receive it as inventory. I understand that. That's a practical expedient or a permitted exception. But then you would have to record it when it's distributed. I could not convince other people on the board here that this made any sense. I argued on behalf of what's proposed, Paul. I got nowhere. I just wondered if anybody else had that same issue.
Thanks, Bill. Paul, just any observations before I go to Jenny, either on the point Bill made about practical expedient or the general experience and the sort of debates within the staff on the approach? Oh, you're on mute, Paul.
Yeah, Karen and I talked about the services in kind and about where we thought we should be trying to draw that line. I think there is a judgment. You can make an argument for a number of different options. I mean, the IPSASB doesn't require it for anything. We thought the idea was if it's something you would normally purchase, then there's going to be a market price, which should at least make measurability less of an issue. In terms of saying it's critical to the NPO's mandate, I think there's, that's a possibility. But again, thinking about one of the charities here, Samaritans, their work is effectively providing telephone support to vulnerable people, and without their volunteers manning the phones, they couldn't operate their service. But there isn't a market price, a market value for any of that, but it is critical to their service. So I think that would give you measurement challenges as well. So I don't think there's an easy answer. The easiest in terms of implementation would be not to require any recognition of services in kind, which is the IPSASB's approach. But it is also furthest away from the conceptual basis, which is you are receiving valuable services and you're not recognizing them. So it's always going to be a judgment call as to where we draw that line. So it's interesting to hear TAG members' views on this, and I think it's probably something we will need to emphasize in the exposure draft, that there are a number of options, and while we go with one in the ED, seeking views on perhaps the range of different options.
Thanks, Paul. Any comments on the practical expedient before I go to Jenny?
I think wording, we can if practical expedient is something that wording that people would prefer, that we can do that. I think we've used permitted exceptions in the consultation paper, so I think that's why I'd carried that wording forward from the consultation paper or something similar. But if there's there is a preference to use the wording that's elsewhere in IFRS for SMEs, then happy to make those changes.
Ian, can I come in on this? Just the term practical expedient, and I don't know, what others think on that. I mean, I normally would distinguish between a practical expedient and an exception. A practical expedient, at least in my mind, is a simpler way of getting to largely the same answer without doing nearly as much work. But you are accounting for something, as opposed to an exception means you don't have to account for something or whatever. So I actually, at least in our standards, we tend to distinguish between the two.
Okay, thanks, Joe. That's helpful. Jenny, to you.
Thanks, Ian. Yes, I was going to say, so we are currently consulting on changes to our standard, and in this area, there are quite a few changes in the drafting, but it's clarification, and sort of, we did have a main standard element and then an appendix, and we've put them together. So we're not intending to particularly change the actual requirements, but we are hopefully making them clearer. And ours is based on things that can be reliably measured, and then we go on to say that usually if it was something that would have been provided by the individual or the entity as part of their trade or profession, for example, then that should be able to be measured reliably. And so donations of services and facilities and things would be based on the value to the entity, assuming they can be reliably measured. And volunteer time in general wouldn't be, unless it was, as say, part of their trade or profession. So we're trying to improve the drafting, but not particularly change the requirements in that area.
Okay, thanks, Jenny. Freddie.
Thanks. So I think I had a comment on the services, otherwise purchased services in kind, because we do have volunteer services optionally recognized. And I think similarly to what Jenny mentioned, we do make a distinction between reliable measurement as opposed to otherwise purchased. We have the distinction otherwise purchased for local government versus and other government or public sector, let's call it, as opposed to not-for-profit entities. But so not-for-profit entities would have option not to recognize. And if they want to recognize, it's only when it's reliably measured. So when I was listening to Paul, maybe there is actually, we can anchor it on a reliable measurement as opposed to otherwise purchase, because as comments were made, any not-for-profit or charity will be dependent on those volunteers. So if they want to function, they would have to otherwise purchase it if they don't have those volunteers, right? Because they cannot operate. Like, what is the other option? Whereas maybe the reliable measurement is maybe even better conceptual way out. And we are just doing the PIR, post-implementation review of our income standards in not-for-profits. And I haven't heard from staff that anyone would be banging on our door to start recognizing volunteer services in addition to disclosures.
Okay, thanks, Freddie.
Thank you.
So I think based on that discussion, it sounds like, Paul, if we can explore something around measurability, which would be similar to where Australia and the UK are. And then I think there is a question as to whether that's a permit or require. It sounds more permissive than requirement might be where we're looking to end up on that. But that's probably something where if you could work that up based on those examples and using that principle of measurement, and then we can have that discussion again around that. Okay, so then move us on.
Okay. The next part is looking at revenue from transactions where there are restrictions but no binding grant arrangements. I think at this point it's worth emphasising that we've taken the IPSASB's definition of binding arrangement and used it for grants and donations, and it's probably slightly narrower than contracts in that it's requiring there to be obligations and rights for both parties. So each party has to have both rights and obligations. So if you have an arrangement where one party promises to give you the funding and you don't have to do anything for that, that might meet the definition of a contract and it may be enforceable in law, but it wouldn't meet the definition of a binding arrangement under the IPSAS or binding grant arrangement here, because it doesn't have obligations on both parties. So it is, I think, worth bearing that in mind. So in those cases where you would have a grant with no sort of obligations, but you may have, there may be terms that say you have to spend this money in this geographical area. There's no specific obligations necessarily that would force you to do that. There may not be any time restrictions on it, so there's nothing that you can be held to. What we're proposing there is it's likely to be a income with restrictions. You would still recognise the revenue immediately, but you wouldn't sort of have any obligations. You wouldn't defer recognition. So we just seeking TAG's views on whether that's appropriate accounting and whether they're comfortable with that view that you could have arrangements which don't give obligations but do have in the old terminology, no conditions, but have restrictions. And for those you would recognise immediately, but would treat it effectively as funds with restrictions, any income that you receive that way. We've also, we have included some additional guidance on multi-year grants as well.
Thanks for comments on those questions. Yeah, Catherine and then Freddie.
Yeah, I'm not sure the best place to make this comment, but maybe I'll just say it now because we're talking a little bit about binding arrangements. One of the things that we've been looking into as we've been developing our new contribution standard in Canada is that how much, I guess, all the gifting that happens online in this space and how obligations are created or perhaps not through those types of mediums when people are, you know, making a donation on a website where there's certain claims being made or marketing materials about how the funds may be spent and that type of thing. And I don't necessarily have a firm opinion on sort of whether we've adequately covered that. I think I need to give it some more thought, but I just wanted to raise that so that the Secretariat could ponder that as well and consider whether are there examples that we need to think about, given that that's sort of a nuance, I think, to the NPO space that perhaps we want to make sure is contemplated in part of this guidance. There can be some strange sort of obligations or potential commitments being made through those types of arrangements that can be a little bit gray. So I think it's worth contemplating that.
Thanks, Catherine. That might be an area where we might want to think about an implementation, an illustrative example or something like that, or even, probably in that area. Paul, did you want to comment?
Yeah, we do have references to, note that in some cases, even if there's no contractual or binding arrangement obligations may arise through other means, which may be effectively a constructive obligation. And we do say in those cases, actually, if you've got a constructive obligation, which may happen with some of these online donations where you've promised effectively to use it in a particular way, that you would then actually recognize the obligation, recognize the liability rather than revenue, and only recognize the revenue as you satisfy that obligation. So we have got that built in as an exception, but yes, I agree, and I think it's probably worth putting an illustrative example in for that scenario.
Yeah, I think it's quite an interesting case, actually. Freddie.
Thanks. I was thinking about the terminology because on the journey at some point I was thinking binding arrangement same as say enforceable agreement. Doesn't look like that, and so this was helpful that my binding arrangement is much narrower, I would say, and it's really hanging on those obligations, whether compliance obligations or otherwise. And I was thinking here in Australia, like when there is a fundraiser or an agreement that someone would argue it's an enforceable agreement, even though it doesn't have any compliance obligations, but it basically provides funds to be spent in line with the charitable purpose, or maybe within the time frame. People will feel like it's a contract, it's an enforceable agreement, but under this guidance, it would not be a binding arrangement. And I think that's where it may be helpful to clarify also the other side of the equation. What's the distinction between binding arrangement, and that is clearly defined, and how does it talk to, especially in Anglo-Saxon law, enforceable agreements and how they are enforceable. And then I think that helped to confirm that any, for example, time-related restrictions would not necessarily result in a deferral, right? If my understanding is correct, which was helpful. So I do think then, yeah, it's not, for that respect, it's probably where WSB 15 would land, IFRS 15 would land in any case. So yeah, I think that's the clarification of how does it talk to the enforceable agreement would help. I'm not sure it's there.
Okay, thanks, Freddie. Paul, any sort of specific comments? I mean, obviously, we've got AG material on binding arrangements and so on.
Yeah, I mean, we have got a little bit more in AGIG examples, but I think listening to the conversation, there's more additional guidance to develop to pick up some of these points, sort of make the links between the two parts. That if you don't have a binding arrangement, it's potentially a restriction, and if it's a restriction, there may still, depending, be those cases where you recognise a constructive obligation and therefore do have some deferrals, but in other cases it would be most cases recognised immediately. So I think we'll look at developing some more more guidance around those areas.
Okay, thanks for that. And obviously look across at what we've got on grant expenses as well, I think. So then move us on then to finding grants arrangements with only one specific obligation.
Yeah, so for binding grant arrangements with only one specific obligation, there's a lot of steps that you don't need to take. You don't need to sort of go through allocating the transaction, so total transaction consideration across the different obligations. It becomes much simpler. We've got this one obligation, full amount applies to it, and you recognize as you satisfy that obligation. So we've put a separate section in for that, because a lot of NPOs, or a fair number of NPOs, sort of grants donations will fall into this bucket, and it's just a very straightforward process to actually you don't need to go through a lot of the steps. So we've put that in as a separate section, just to simplify the process for NPOs, and just seeking TAG members' views on that.
Okay, thanks, Paul. And I think obviously to the earlier points, then being absolutely clear in the drafting about which steps then we then don't need to go through, referencing that 5-step model. Jenny.
Thanks, Ian. Sorry, I just wanted to say something about multi-year grants, which I think I might have missed. And I just wondered whether, I mean, I know with multi-year grants, there's obviously, generally a desire to spread those over the years, but I wondered if we were perhaps assuming too much that they should be spread, and presumably it depends on the terms and conditions involved in the actual arrangement about whether that really is appropriate in all cases. I mean, I don't have any particular examples, but you can imagine that if the wording's not very precise, even though that might have been the intention, it might not be actually what is agreed, depending on the arrangement.
Yeah, we have developed an illustrative example on multi-year grants that effectively has the two cases, one where you would recognise up front and one where you would recognise so much each year. So hopefully that will address that
issue.
Should
cover that. Yeah. Okay.
Yeah,
all right. Thank you.
On compliance obligations, but I thought it was helpful you made the link into executive contracts there, Paul, as well.
Yes. Yeah. That people haven't necessarily fulfilled. Yeah.
Yeah. Okay. So move us on then to the next questions, Paul. Oh, sorry, Easton, you want to come in on
that? Yeah, it was just a point on the language in paragraph G23.68. And I think here you're saying an entity shall refer to step 4 if necessary. And I thought that was quite interesting that you're introducing a level of sort of optionality around that body of guidance, whether the revenue is recognised point in time or over time. I didn't know if that was the intention, but it seems if guidance is there that's relevant, an entity should be required to look at it rather than choosing not to. So it was just whether that that was the intention of the way that those two words are included at the start of that sentence.
Yeah. I don't think it was intended to bring in optionality, but I think in some cases it's going to be so clear that you don't actually need to go through all the guidance to do that. So, for example, if you've got an agreement which is satisfied because it's a point of sale in a shop, you don't need to go through all the guidance to see, well, is this satisfied at a point in time or over time? We've sold the goods in the shop at a point in time. It's done. So I think that's what we were trying to say. You don't need to refer to that unless it's unclear. So perhaps we, making a reference to unless it's if it is clear whether it's over time or at time, you don't need, if it's not clear whether it's over time or at a point in time, then you refer to section 4 for the guidance. If it's clear, then you just proceed. Perhaps that's making that sort of reference will be easier. But I think I was trying to avoid directing people toward the detailed guidance for the simple transactions where hopefully it's clear and there isn't any debate about which one it is.
Okay, thanks, Paul. And I think just go back and check that through again. Freddie.
Sorry, one additional question before we move on. When I was going, I just realized that can be there a case that there will be a binding arrangement, but with restrictions? Because I think we have categories without restrictions, with restrictions, but without binding arrangement. And then we are going into the binding arrangements with compliance obligations, one or more. But is there another case, binding arrangement with restrictions? And I just went to the definition of binding arrangement, and it's more about enforceable rights and obligations, which I'm not sure whether it's just another speak for compliance obligations, and going back to my previous comments, that maybe some enforceable contracts that don't have compliance obligations. So I'm not sure.
Yeah. There is guidance in the IPSAS, and I think we've taken it through, that says if you have a binding grant arrangement, there will always be at least one compliance obligation. So it's always linked back to compliance obligations. I think in the way that we have in presentation of financial statements separated funds with restrictions and funds without restrictions, I think everything that's subject to a compliance obligation is going to be restricted, because you have to do certain things. You can only use the funding for that thing. So I think everything within a binding grant arrangement is going to be income with restrictions, funds with restrictions. But I think it will always link back to a compliance obligation.
Because to extend that, then I question whether would be not helpful to have that reference to compliance obligations in the actual definition of binding arrangement, because at the moment it's at least to me, when I was trying to make sure that we've exhausted all possible alternatives, there was a bit gap there, but maybe just my impression.
I'll have a look, but I think if we've got that paragraph that says every binding arrangement will have at least one compliance obligation, then we can perhaps bring that up, reposition that so it's forms guidance to the definition and makes it clearer for people.
Excellent, thank you.
Okay. I mean, it may be that we need something more general about terminology to position this before you get down into the detailed guidance, because then you need to sort of cover off the sort of situation where you have a restriction but not a binding arrangement, and that could well link into you don't have a present obligation at the moment, but you might there's something that could generate that in the future. Jeff, I'm mindful of time, so I don't want to get into a big debate on this. I think we just log it at the moment. But
no, not a big debate, but this was a comment that I was going to make later. I think there was an example somewhere, I can't remember which paragraph, but Paul just mentioned that pretty much any situation where you have a compliance obligation, you're going to end up recognizing restricted revenue as opposed to revenue without restrictions. Let me just give you one example there, and I'm not, and that is a matching grant where you have to go out and raise funds from others in order to be entitled to the grant. But otherwise, the funds could be for any purpose consistent with the mission of the organization. That's an example to me, and there are some, at least here in the States, where you have a compliance obligation that, where you have to actually raise from outsiders or whatever. But there is, I would argue that that's not restricted when you do recognize it. So, but generally the answer, yes, it'd be restricted. I'm not sure that would always be the case.
Yeah, but in that case, then it'd be restricted until you've actually raised the match funds, and then it becomes unrestricted.
Well, I would argue it's not recognized until you've again, depending on exactly how the agreement is worded. But you would not recognize revenue until you've raised the match funds. But then when you are entitled, then what you would recognize would be without restrictions.
Thanks, Jeff. So I think that underlines that we're going to have to just think somewhere we need something that just sets out this terminology and how that fits together. Because there clearly is you know, I think it can work, but I think we just need to be clear about how it fits together. Okay, so I'm going to let us run till on the hour, and then we're going to we'll take a break and then we'll move on. So Paul, move us on to questions 13 and 14. You're on mute.
So this is looking at the guidance for binding arrangements with a number of compliance obligations. So it's based on the IPSAS, effectively drawing on IFRS for SMEs. So it's very similar effectively to part 2, although there are some sections that we've omitted because they're, you know, things like refund liabilities, for example, are unlikely to be relevant to grants and donations. So we've omitted those. There is guidance in, I think it's implementation guidance, which sort of shows the parallels between the two parts. It says if you've got these transactions which would very rarely occur for grants and donations, then you can rely on the part 2 guidance. But just checking that sort of members are generally happy with the drafting or with the proposed accounting for these, and conclusions regarding compliance obligations effectively being the same as the goods and service, or very similar to IFRS for SMEs.
Any comments on that? Okay, I think we're fine on that. So move us on then, Paul.
So next couple of questions are around the disclosure requirements. We've basically taken these mainly from section 23 because the disclosure requirements in IPSAS and, you know, consistent with IFRS 15 are quite voluminous, and it didn't seem appropriate to bring all of those into INPAG. So we've based the disclosure requirements on section 23 of IFRS SMEs, with obviously adapted to the MPO context and including additional disclosures where you don't have those compliance obligations, because there'd be nothing equivalent in the IFRS for SMEs for those.
Okay, comments on that approach? Yeah, Jeff.
Yeah, this is where I'd actually really be curious to hear the reactions for folks who are commenting on IFRS or SMEs, because the disclosure requirements are pretty voluminous, even with those pairbacks.
Thanks, Jeff. I think we'll have to sort of see how we handle that in the context of timing and processing the comments on IFRS for SMEs update versus when we need to get ED2 out. You know, and that may well be something that we do want an SMC on. But I suspect we'll get the feedback anyway. Okay, so let's just do the final questions and then we'll take a break. Paul, anything you want to say before I open up?
I think the final questions are around revenue from contracts with customers. So part 3, all we've done with part 3 is effectively take the section 23 from IFRS SMEs, update the terminology. There is additional guidance that we've included about trying to help people with simpler transactions, sort of pointing out which paragraphs are only going to be relevant in certain circumstances and can be ignored if you don't have those circumstances. So location for that, I think we've now put it, latest draft now has that in application guidance. I can't remember where it was for when we issued the TAG papers. And then just any general comments on this.
Okay, thanks, Paul. So any comments on those final 3 questions? Yeah, Easton.
Sorry, just before people want to come in on those, I just had a few questions on part 1 text, question 16. It's just 2 points again, whether guidance is necessary on costs of fulfilling the contract, given that that seems to be covered in relation to section 24 partly, or in relation to another section of the guidance, and also a non-cash consideration. So whether that is covered already by services in kind and goods in kind, which again, if it is, then that's good because it'll make the section a little bit smaller.
Okay, thanks, Easton. So, Paul, perhaps you can take those away and have a look at those. Jeff?
Yeah, my question really is, the draft that we were given, I think, has one illustrative example in the implementation guidance. Question is for Paul, how extensive do you expect the illustrative examples, or not how many, do you expect a lot of illustrative examples? I mean, we have, for example, in chapter 24A, we have about 5 or 6 of them. There's one so far, and I guess the question is, are there going to be a lot of those? Are they primarily going to be more about part 1, or are we also going to be illustrating, simple revenue transactions as well? I'm just sort of curious as to kind of what sort of plan do we have for illustrative examples in this chapter?
I've been working on those since the tag papers went out. I think I've currently got 9 illustrative examples. There are a couple more that I think have been identified today that will need to be drafted as well. So we're probably going to end up somewhere between 10 and 15 examples. And at the moment, they're all either on the preface, so how you decide which part you're in, or in part 1, because we've taken the rules of the road approach to part 2, which is that we don't provide a lot of supplementary material. We've just taken it as is. There were no NPO specific issues identified with exchange revenue contracts with customers, so we haven't done anything other than based on the comments we had for part 1, put in a table which says if you don't have variable consideration, ignore these paragraphs. If you don't have this, ignore those paragraphs, just to try and help people get through part 1 without having to apply or go read everything if they don't for the simpler transactions. But we hadn't planned to do any examples for part 2, given it's a rules of the road type approach to it.
Good. That's actually what I was kind of hoping you would say, that that we'd extensively illustrate whether to go into part 1 versus part 2, the preface, basically, and all the part 1 stuff. I don't think we necessarily need, unless others disagree, examples for part 2.
Okay. Thanks, Jeff. Karen.
I was just to come into that to say that I've been reviewing the examples that Paul has been writing, and I think our challenge is going to be is keeping the number of examples at a reasonable level whilst demonstrating the range of different conditions that are here, and we may need to kind of look at how do we do that. So I've given some feedback to Paul, which probably hasn't had a chance to have a look at yet, but I think that is going to be the thing that we're going to have to try and navigate, because as I was looking at them, I could keep adding things to the list, and clearly we don't want to do that. So we just need to try and keep it at a manageable level.
Yeah, I mean, for context, the IPSAS has over 50 examples. I think we want to be a lot shorter than that, but if there's 50 examples, because you can see a need for 50 examples. So yes, it's a challenge.
Yeah, we have been through a process on that, and we thinned them down compared to the 2 exposure drafts when you put them together. And even with that, people always want more examples.
Yeah.
What we have done though is we have thinned it down using implementation guidance, as I've been out a number. So anyway. Okay, so thanks for that, Paul. I think that's actually been, a long-awaited, go through the revenue material, and I think there's a number of points to pick up on there, particularly on services in kind. I think, as ever, if people can pass the various different bits of drafting they've identified over to Paul, that would be really helpful. I think that probably gets us through that item, doesn't it? Or nothing else you're looking for from us?
No, I think that's covered everything. Thank you.
Okay, good. Right. Well, I think with that, it's time to take a break. I think we've had quite a heavy session on that. So I think if we say, if you can come back at 10 past, and then we'll move into grant expenses at that point in time. Okay, thanks everyone. So start. Great. Okay. Well, I think people are coming back online now. So, Phil, I'm going to hand over to you then to take us through the next paper on grant expenses.
Thanks, Ian, and hello, everyone. I'm conscious of time, so I'll just crack on. So the previous meeting, TAG members were provided with an overview of the approach taken to the development of the proposed guidance for grant expenses and an initial draft of the authoritative guidance. A number of comments were provided by TAG members, which we've aimed to reflect in this draft. So I'll get straight on to the significant changes that we've made. Firstly, the title of the section, we have changed it to expenditure on grants, donations, and similar transferred made by MPOs to other entities and individuals. This has been made to clarify the expenditure relates to transfers to other entities and individuals by the MPO, including donations and similar transfers, as well as grants. There have been minor changes to the definition of grant expenses to include obliged to provide at the request of the PAG. And we've also replaced the terms satisfaction and extinguished with fulfillment and met, which it was deemed would be more user-friendly. The biggest conceptual issue, and one which I think it is worth us spending some time on now, is around rights and obligations, and it links very closely to the discussion we've just had around revenue. So we've been trying to draw a distinction between those rights and obligations that relate more to a grant recipient's overall purpose and those that are related to specific programs, projects, and activities that they may undertake. The timing of the paper development and clarification discussions held with the IPSAS-B meant, unfortunately, we weren't in a position to fully align revenue and expenses here. But I think in some ways that is beneficial, as it allows TAG members to express their preference on approach and potential impact on recognition and measurement. So for expenses, we have distinguished between general obligations and specific compliance obligations. So I think as the paper notes, the IPSAS approach is that a compliance obligation is a grant recipient's promise in a binding arrangement to either use resources internally for distinct services, goods, or other assets, or to transfer distinct services, goods, or other assets to a purchaser or a third-party beneficiary. I think what counts as distinct here is crucial to our discussion. So for expenses, we've noted that where there is a general obligation, the services, goods, or other assets to be used internally or transferred externally may not individually be distinct, but collectively are likely to be incremental to services, goods, or other assets that would have been available to the grant recipient for internal use or external transfer if that resource transfer from the grant providing NPO hadn't occurred. So for expenses, we're effectively saying that if it is related to the overall purpose, this may be sufficient to create a compliance obligation, and hence for there to be a binding grant arrangement. Practically, though, I think where there is a general obligation, it is likely the grant providing NPO wouldn't be realistically able to avoid a transfer. and hence it is likely to recognise an expense when the binding grant arrangement is put in place, which would differ to a specific compliance obligation. This differs, I think, to the revenue position, where effectively such general obligations are probably going to fall in that restrictions bucket and will not be sufficient for a binding grant arrangement to be deemed to exist. If this is the approach that we do take for expenses, where these general obligations aren't sufficient for a binding grant arrangement, we would need to make a change to the recognition and measurement requirements that are noted in the paper. And I think particularly this would hit revenue from transactions without binding grant arrangements. This might result in recognition of grant expenses on transfer, as we have where there is a binding, where there isn't a binding grant arrangement, or we could see recognition when the grant agreement was made, where it included a general obligation. So there is a conceptual issue here that I think we need to get agreement on, ideally at this meeting, because it will have implications for the drafting. So if we could look at question 1 now, for the title and terminology, if we could cover that first. Are TAG members happy with the changes made specifically on the title and terminology?
Thanks, Phil. Bill, kick us off.
I thought the title was too long, and I think it could simply be grant dash providing expenses or expenditures. Just grant providing expenses. It's explained later, and I understand that throughout the document you refer to grant expenses, saying it includes all of these things, but I thought the title was just too long, and I don't know why it couldn't simply be grant providing expenses or expenditures. I don't know which is better. Just a recommendation.
Thanks, Bill. Jenny, on the same point?
I thought the title was okay, but the thing I was a bit confused about, and maybe it was just me, was the definition of a grant expense, because the grant expense, it seems to have really moved away from grants to be sort of any expenses of the NPO really in providing its activities, because where we're talking about by transferring cash or a service or good or other asset to a, another party, that seemed to me like it was encompassing sort of all program work, and I didn't know if that was what we were intending to do, or if we were trying to pick up really situations where we're transferring mainly cash, but it could be other assets, to a body who then went on to do either use it themselves or do something else. But we seem to be including everything, and I didn't know if that was correct. Thanks.
Thanks, Jenny. So back on those points, Phil, I mean, I have some sympathy for Bill's points about, I think it is too long, so we need something shorter. But anyway, back to you.
On Bill's point, the PAG were clear that they were quite confused with just grant expenses, and they didn't think it encompassed everything that we then go on to include in the section. So their strong steer was we needed to include the other kinds of items that might be included within the title itself, even if we then reverted immediately back to grant expenses in the main text. I will try and find a happy medium. I mean, the main thing we're trying to show is that this is about the expense of the grant providing NPO, and it is not related to the grant recipients, effectively their use. It's the grant providing NPO transferring something, and it's that expense that we need to get. So I will muse some more and see if I can come back. And then on the definition point, the only change we've actually made to the definition is we've added or obliged to provide. So hopefully, I mean, reading through it, I see it as we've intended, but I'll look to see if there is a better way that we can include it to make clear that if it is the recipient then transferring something else, it isn't causing that confusion that this is the expenses, say, of the recipient, that it is that first grant providing NPO's expense.
Okay, thanks, Phil. Jeff and then Catherine.
I was just going to come in. I think, Phil, you're going to be doing some musing on this. Our standard in this area which is a little broader than grants, is accounting for contributions received and contributions made. So in that vein, I guess this is similar to grant providing expenses. I would have said grants made or something like that would be sufficiently clear. But again, you can wordsmith all of that.
Okay, thanks, Jeff. Catherine.
Yeah, just similarly on the title. Again, I won't spend a lot of time, but the made by NPOs felt redundant to me because this is a standard set of standards for NPOs. So if it's expenditures, it seems clear to me that at least that little part of it could probably come out.
Okay, thanks. So then can we move on to the point of principle?
Yep.
Then and get input on whether general actually works or not, whether it takes the model too far.
Phil, I think it might be worth just repeating.
Yeah,
how we've defined a general
general
obligation, just to make clear what's in that and the difference.
Yeah, if I define them and then attempt to provide a sort of defense as to why I think it might be valid, because that might be easier then for people to play off. So a general obligation is one that it doesn't relate to distinct services, goods, or other assets, individually distinct. It is very much an obligation on the grant recipient to spend or use the transferred resources on its overall purpose. So say if you were let's say a cancer research charity, a grant providing NPO might provide you with $1 million to spend on, say, cancer research, whereas a specific compliance obligation would be that grant providing NPO giving you $1 million to spend specifically on research into pancreatic cancer. So the distinction there is one's the overall purpose, which is cancer research, and the specific obligation is spend it on this specific form, say, of cancer research. I need to see that you're doing it on services and goods directly related to pancreatic cancer. My sort of defense of the general obligation being sufficient for it to be a binding grant arrangement. I, as a grant providing NPO, I'm giving this for the entity's overall purpose, which is cancer research. I would not expect it to then spend that money on things unrelated to its purpose. I wouldn't expect it to then go out and start a new commercial entity that is in no way related to cancer research. The obligation is on that entity to spend it on cancer research, and my right as the grant provider is to see that resource spent on cancer research activities. And if I'm giving that $1 million, I'd expect actually that to be incremental to whatever the entity was originally going to plan. So that $1 million is getting something else. The alternative view is that's not distinct enough, that this is a fairly general obligation. Well, it's in the title. This is too general, and I don't have that kind of right, and the individual entity doesn't have that kind of obligation that is specific enough to fall within the binding grant arrangement world.
Okay, thanks, Phil. And I think there are some interplays with the discussion we had earlier about restricted, and also the point about this model, which is actually what is it that justifies deferral of expense recognition. So I think those are the things we just need to focus on. So Freddie and then Jeff.
Thanks, thanks, Phil. And yeah, when we were discussing this, and we'll discuss this again here locally, one comment was made: what if the grant, especially if it's general, what if the grantee will choose to deliver that internally using, for example, volunteer services? Is there then ultimate outflow of resources to third party? And well, ultimately, as you just said, Phil, probably somewhere there will be, because it's all incremental, and so somewhere the money will go out, but is it attributable? And I think we were trying to find the boundary, and I think the volunteer, something done internally without actually explicit outflow, especially if it's defined generally as a research or delivering of a objective, whether that was sufficient to defer the expense, if you want. And I think the question was then maybe similar question I had on revenue side. Did IPSASB need to do anything specific in the conceptual framework, or is this all good in the existing one? So we are not necessarily stretching any concepts and definition of asset and liability. Don't have the solution though.
so just on that, Freddie, I mean, obviously IPSASB did encounter this, and we had proposed some changes to our conceptual framework on transfers specifically to address this and to allow that to take place. So that's something that we're improving in tandem with the transfer expenses standard week after next. That's the idea. Jeff, did you want to come in?
I do briefly, at least, Ian. You actually already made much of the points that I was going to make about, I think we're blurring the line here between a compliance obligation and a restriction, because the distinction that Phil is making here to me sounds more like unrestricted versus restricted. I think it's, as you were pointing out, Ian, and I think it's more about, is there something specifically that has to be done or that has to happen in order for the organization to be entitled, and therefore this organization to be obligated to make that payment. And I'll go back to that example that I gave before, because I think it does test the boundaries here, which is a simple matching grant for general operating purposes. Again, it's something specific that has to be done or that has to happen. They have to raise matching funds, but the resources will be used for the general purpose of the organization. So just got to, I think, be careful here what we're trying to illustrate.
Thanks, Jeff. Any other points on this? Because I do think where you get to is actually the model depends on there being a compliance obligation that justifies deferral, and to your example, Jeff, clearly until you've raised the match funding, you can't recognise the revenue or the expense wouldn't be recognised, looking it around the other way. But once you've met the compliance obligation, then there's nothing that, so I think there is to my mind, and this is just speaking personally, I think, I don't think general actually really works. I think the compliance obligation is the key thing linked to the binding, as a way of enforcing the binding arrangement. So
yeah, I mean, I was just going to say, Ian, just agree, and to me, it gets down to at what point is the recipient organization entitled and the granting organization obligated. It's not what the ultimate purpose of the funds are.
I mean, I think we do need, there's no doubt about the fact that we do need to underline this difference between restrictions and compliance obligations and how that works. And that's probably really what we're talking about here. Are you okay then, Phil, on that? Do you want to come back?
If it's the tag view that general is insufficient, because this then leads into the structure question that we're coming to next, because we will need to make some changes to structure. So if the tag view is that actually a general obligation is not sufficient to be a compliance obligation, then those kind of general obligations would fall into the grant expenses from transactions without binding grant arrangements. So we'd effectively be moving that expenditure up into the first part of the model. The question then is, in terms of recognition and measurement there, and timing of recognition in particular, Because for these general obligations, the question then from a grant expense perspective is, are you recognizing when the grant agreement is signed, or are you effectively recognizing the expense when the resources are transferred to the grant recipient? And we'd need then the conceptual basis for deciding between those two. So it's not a compliance obligation, but it is, when does the obligation occur? Because I think on the revenue side, we're kind of erring on revenue recognition on transfer, on the receipt of resources, unless there is something. And it's, do we want to do the same from the grant expenses perspective? Are we erring on recognizing expenses on transfer unless there is a very clear, say, legal obligation on the signing of the agreement that that transfer will definitely occur?
Yeah, I think, again, I'd have to go back and reread this, but I think you, other than making the distinction that you did between general and compliance and specific compliance obligations in a way that sounded like restricted versus without restrictions, I think the results of your model and the general model and the general structure was good. I think it does come down to, if it's of a general nature, or it doesn't have specific compliance obligations, is there a way to avoid it or not? I think you can parallel what you did largely on the revenue side. I think it's just, I think where there's been confusion that's been interjected here was drawing a distinction, but that sounds too much like restricted versus unrestricted. So if we then effectively mirror, we can then more closely mirror the revenue structure. I think so, unless others disagree. I think that structure seemed to work pretty well. And I see entitlement versus obligation being just flip sides of the same thing.
I mean, I think if you go this route, being clear about what, the interplay with restrictions, I think it takes you back much closer to the draft IPSAS on transfer expenses, where you've got material on that, addressing those issues that you mentioned, Phil. Fabulous. And if there are no other comments, well, the next question then was on structure, and it was specifically related to how we've structured the recognition. Are you still in, or are you? Okay. Sorry, Phil. Yeah. So the next question was on structure and making the distinction between general, specific, and whether there are multiple obligations. If we remove general obligations and slot that further up into the first part of the model, then we'd just be effectively changing that structure slightly, and we'd have where there's one right and one obligation, or where there are a number. That will be fairly simple to change, provided people, tag members, actually think this structure works. Okay. So any other comments then on structure? I think we're okay on that, Phil. Fabulous. 2 is fine. Okay, so moving on from structure, we have made changes to the financial instrument disclosure proposals. So initially we were looking to amend section 11 to include grant prepayment assets and non-monetary grant payment liabilities. I think tag members were fairly strongly of the opinion that that shouldn't happen, and that ideally we could just put it directly in this section if it was needed. So that is what we have looked to do. If we could actually ask a question, if members are happy with that, Ian, because the sensitive information one isn't directly related to that. Okay, so just check whether anybody's got any comments on that. Okay. Fabulous. So moving on to sensitive information exemption. So in comments on the draft authoritative guidance, I think Catherine raised the point that actually we may need to consider the sensitive information disclosure. I think it was raised in particular with principal agent considerations and discussions on acting on behalf of another entity. Looking at that, I think the sort of
disclosures we have around grant expenses, actually, we think that the nature and content of the disclosures means we may need a sensitive information exception, which encompasses all of the grant expenses disclosures, to ensure that we aren't requiring grant providing NPOs to disclose information that would put either them, their staff, or those that they work with at risk. I think some of the outreach we've had in the last couple of weeks, there's been very strong support from practitioners on the general sensitive information disclosure on narrative reporting, and the kind of information we'd want to include in grant expenses, I think it also needs to be covered. So it's whether members are happy, one, that we include this, and two, that they are content with the breadth of the potential exemption.
Okay, thanks, Phil. Comments on that? I think SAG members seem okay with that.
Fabulous. Okay, so if we move then on to, so that would cover the full text of the core guidance. So in terms of changes, then it's to bring general obligations up. But other than that, I think members are fairly content with where we've landed. For the application guidance, there were requests for some additional guidance on enforceability in a number of areas. So we've looked to add these to the guidance. First is alternative proposals that have the equivalent effect to legal means. I think this is mainly going to relate to public sector entities that an NPO may be in an arrangement with, where certain public sector entities may not be able to contract, say, in their own names, but there are alternative mechanisms that effectively allow through things like executive orders or ministerial directives for quasi-contractual and quasi-legal mechanisms to occur. So we felt it was important to put that in, even though it is very public sector focused in terms of the entities that will be affected, because grant providing NPOs may be providing grants to public sector entities. The second is relating to whether the ability to reduce or withhold future funding is an enforcement mechanism. So we've looked to clarify in the application guidance that this only relates to mechanisms where it is directly related to that binding grant arrangement or is written into another binding grant arrangement. Just the threat that you may withhold some potential funding in the future isn't sufficient for it to be an enforceability mechanism. The third is to do with the difference between general statements of intent and oral agreements. So we've included guidance noting that a general statement of intent will not usually in and of itself be sufficient for it to be an enforceable arrangement, but it could give rise to a constructive obligation. We have, though, drawn a distinction with oral agreements, which we've noted may be sufficient, particularly in those jurisdictions where oral agreements can be legally binding. So that is certainly the case in the UK. I'm not sure in terms of other jurisdictions how common that is. And then the final additional text is on customary practices and the extent to which legitimate expectations may arise and could be upheld by a legal or equivalent mechanism. Again, I think this is going to vary by jurisdiction on the legal or other mechanisms in place. This may be one actually where it is more applicable to public sector entities. I'm not sure the extent to which legitimate expectations legal mechanisms are applying to the sort of private NPOs that we'd expect to be applying the guidance, but we felt it was worth putting in for the sort of belt and braces should it be relevant to a jurisdiction.
Okay, thanks, Phil. Comments on those changes? Yeah, Easton, and then Jenny.
I just had a question on the final one about enforceability of customary practices. Just is that, and forgive me if it is that taken from IPSASB guidance? Because it seemed to be more possibly higher hurdle than the ISB's conceptual framework in relation to, although it doesn't mention constructive obligations, it does reference that idea of customary practice doesn't need to be explicitly linked with enforceability. But here we are making the link. I'm just wondering where that's from.
Yeah, so I've found that, Ian. That's from the IPSASB draft guidance on transfer expenses, which is why I thought it was worth noting here that actually this is probably more directly related to public sector entities. I think in terms of that sort of legitimate expectations versus constructive obligations argument arising from customary practice, I think this is one that is probably more likely to be relevant to the public sector. That said, because we can't say who will or will not apply this guidance, and it may be taken up by sort of maybe government-controlled MPOs that have sort of quasi-government roles, it may still be relevant, which is why we've looked to the IPSASB draft guidance here.
Okay. Thanks for that, Jenny.
Thanks, Ian. Yeah, I was just wondering on those general statements, how likely it was that they would be could result in a constructive obligation. Because, I mean, maybe it depends what we're thinking of by a general statement, but usually it would be, I'd have thought, not specific enough to create a constructive obligation. So, I mean, I suppose that maybe there could be cases, but I'd have thought usually it would be too general.
Go back on that.
Yeah, so it's why I've looked to include one of the examples relates to when these kind of general statements could potentially be seen as a constructive obligation. I think you're right. Normally they will be seen as too general, but I think there is a potential, particularly if they are linked in some way to another enforceable obligation on an MPO, that it's a possibility. And as it is in the model, I think additional guidance on when it may be enforceable was needed.
Yeah. Okay, thanks.
Thanks for that, Phil.
Phil, interestingly, you just used a term that sounds like a good name for this section: transfer expenses. I just thought, when you said that, I thought, well, that solves the problem, doesn't it? Doesn't it address almost everything we've said up till now? Just a comment. It sounded like it does.
If other members are happy, Ian, if you're happy with stealing IPSASB's intellectual
I was just going to say, I think for us accountants sat in the room, that makes absolute perfect sense. I think the issue is, and Sam may have a view on this, is that MPOs won't recognise it. They understand grants and donations. That's the language that they deal with. And I see Sam nodding. So I think we still need to go away and muse, I think, despite that suggestion. So, but thanks, Bill.
Yeah. I mean, the history behind the IPSASB terminology was actually, it goes back into one of the objectives is to try and get alignment with statistical reporting and transfers, and the definition started from the statistical world where transfers can be income or expenditure, and we just basically cut it in half and said, right, okay, we've got transfer expenses. So I think probably, Phil, it's probably a good idea to sort of have a think, give us 2 or 3 options, and then we'll just kind of work out which one of those we like. We had a similar thing, just for information, on compliance obligations. We went around various different variants on that, and not everybody was happy on that one, but we landed on that in the end, sort of majority views. So, Jeff.
I just wanted to pile on here beyond Sam. Again, the word transfer expense is really not, I've not heard it in the private nonprofit sector very much, if at all.
Mm-hmm. So I think that's not on your long list, Phil, but open to other ideas and suggestions from people, I think. And then we will just kind of, have a look at a couple of suggestions, and I think we'll probably just go with one of them. dependent on member views. So maybe we'll just do that next time round. Okay.
That's fine. I just wanted to throw it out there because when he said it, I thought, sounds like a solution to a problem. Maybe it's not.
Would it work? Okay, thanks, Bill. Maybe on.
Yeah, so the next area of application guidance, and I think one that Jeff M may disagree with, is on grant recipient obligations. So there was questions here in particular on the example of match funding that we provided. So the example is where you have a grant providing NPO that's going to provide resources to a grant recipient, and that grant recipient needs to secure match funding to enable that transfer to occur, and whether the grant provider would at any stage recognize a provision prior to that match funding being sort of fully secured. I think applying the IPSAS model, you would, if it was probable that the transfer would occur, that match funding will be secured, then the IPSAS model does require you to look at recognizing a provision. So I've adapted the example to basically say that the grant recipient is in very advanced stages of securing the match funding, which means it's highly likely. But there is their overall conceptual issue of, do we think that this is appropriate in the NPO world for this specific time of grant recipient obligation? Because it also then has follow-ons for other potential obligations that the grant recipient has, and whether a grant providing NPO would recognize expenses in those circumstances as well.
So Phil, I think I'm right in saying in IPSAS we then tied that into essentially the sort of IS 37 provisions model. Okay, any comments? Yeah, Jeff.
I mean, obviously, I disagree about the, calling it restricted or whatever, at least on the recipient side. I certainly in US GAAP, we don't do a probability assessment here, but, I understand there may be other reasons to do it depending on what you're looking to. So I don't have a strong view on that.
Nice. As I say, I mean, it was, we deliberately tied it into then the general requirements in terms of provisions, which is where that kind of comes in, recognizing the challenges around that. Okay, move us on, Phil.
And then the final application guidance area we had, it was missing originally while we were beginning to look at foreign currency translations, but we have included some guidance on where a grant providing NPO may have a foreign currency grant prepayment asset or grant payment liabilities, and the need to restate those into the reporting currency using the applicable exchange rates as at the reporting date. I think from what we've heard in terms of actual practice, it's probably not going to be that likely that grant providing NPOs have these, because they tend to provide in their own currency, and most of the risks and issues and difficulties are actually on the grant recipient side. But for a sort of belt and braces, this basically follows the IFRS for SME's approach to foreign currency translations. So there is nothing unique and new here. It's just that we wanted to ensure that there was guidance if grant providers needed it.
Okay with that? Good. Okay, move on.
I am conscious of time, Ian. The next areas are the implementation guidance examples and basis for conclusions. And the questions for these are effectively, are TAG members happy with what we've included? And are there any further areas that we should include for all three? So I don't know if it's easier to discuss this now, or if these are areas that actually might be, if people do have more specific drafting comments and things they expected to see in each of these, whether they'd like to see, they'd like to send them to me directly.
I mean, I think that probably makes most sense, unless there are any major issues anybody wants to pick up and discuss. No. Okay. Good.
Fabulous.
Right. So I think, Phil, that's given you everything you're looking for.
Yeah, that's perfect.
It's offline.
Thank you.
Great. Okay. Thanks for that. So with that, we move on to paper 3, foreign currency translation. Welcome, Nigel, for the first time. So, Nigel, if you want to lead us off, and also I should say thank you very much for getting up to speed on this pretty quickly.
Okay, thank you, Ian, and hello to everyone again. So on foreign currency translation, as was agreed at the September TAG meeting, the existing core guidance was deemed to be sufficient, and so the focus in the main is on providing further guidance, particularly implementation guidance, to assist with understanding how foreign currency translation would apply to reporting of and presentation, particularly in relation to areas like restricted grants and donations. And that forms the majority of the material that's been presented. But just starting from the top, there have been there's some small changes in the core text and also some application guidance as well. So probably best to pick those up first. So within the core text itself, there have been very little changes, mainly the normal ones of description or for NPOs. But an additional requirement included to separately present gains and losses related to restricted funds, FX gains and losses, from other gains and losses. And so the question one is do TAG committee agree that members agree that the scope of changes as presented is fine? And then the second one is are they happy with the this proposed additional requirement?
Okay, thanks, Nigel. Jeff G.
Yeah, I just wanted to understand what was done. This is foreign currency. This is not foreign currency translation. This is the FX gain or loss on a grant denominated in a foreign currency, and it's the FX gains and losses on those in your reporting currency, correct?
Correct.
So, I mean, I just wanted to understand better what was the reason for what's the reason for separating these out? I wasn't fully clear.
Yeah. So in discussion in working groups with PAG members and so forth, it was clear that one of the big areas of concern is the impact that foreign currency can have, or changes in foreign currency can have on the grant recipients as the rate moves against them, for example. And the lack of understanding of that, often from the donor's perspective, but also, I guess, from the other users of the financial statements. And so greater transparency of this issue, I think, is certainly seen by some respondents as helpful.
Okay, thank you.
Thanks for that. Karen, did you want to come in before I go?
Yeah, no, as Nigel has said, I think the key issue here is about transparency. And so what has been stated to us is that many NPOs can find themselves in the situation where they have to fund the obligations under a grant agreement from unrestricted resources. Because they have got an obligation to provide something, but because exchange rates have moved, the amount of revenue that they're getting is not sufficient to meet the obligations. So the foreign currency gain or loss actually is not being funded by the grant that's being provided. Actually, it's been funded from their own resources. And so the point of this disclosure is to provide transparency that actually the grant being provided is not sufficient to meet the obligation. So that's that's the intention of what's been proposed.
Thanks for that clarification, Karen. John Chow?
Thank you, Ian, and thanks, Nigel. Just one small question, maybe clarification in terms of foreign currency gains and losses arising in relation to restricted funds. Because when I look at the additional wording added in, I think that is paragraph G 30.26. That sounds like that is an option. That is, we require those entities to either present in the statement of financial performance or rather or in the notes. But when I look at the question 4 or your introduction, sounds like it's a requirement for ask those companies to present separately. So I just want to make sure whether it's a requirement of presentation separately or it's an option. They can choose to present separately in the face of the statement or in the notes. And another thing is that the wording you added actually in paragraph G30 is actually obviously it's from our SME standard, that is only about disclosure requirements rather than presentation requirements. So yeah, I just maybe further clarification. Yeah. Thank you.
Thank you. So the intent in the way that's drafted, and perhaps we need to look again at the drafting for clarification and your point about where it lies, was to give an option as to the location of the disclosure, so that it could be on the face or in the note. But the requirement was that it was in one or the other or both. But so the required part is that the information is available in the financial statements. The optionality was around where you put it.
Yeah, because in the terminology we're using, presentation or disclosure, because currently under IFRS standard, normally when we use presentation, that means those information should be presented in the face.
Okay.
So when we use we require company to disclose that means disclose those information in the notes. So I think just make sure, because this is from our section 30, so
that is a helpful clarification that would be required. So that's what intended. So it looks like the way that is currently drafted would need to be modified to meet what was intended.
Thank you.
Okay.
So move us on. I'm not seeing any other comments. So move us on then to the application.
Yeah. So moving on to application guidance, and this was included to provide some additional clarity. It's worth noting that again, in discussion at working group, there was a lot of discomfort around the use of the term functional currency at all. Terms like home currency was seen as more widely understood. So I haven't taken the route of going of changing functional currency into a different terminology, but I have attempted to provide some greater clarification of how it applies both here in the application guidance and again much more fulsomely in the implementation guidance. The other point included as well was the use of a presentation currency, and the application guidance explains the purpose of presentation currency, again because this was seen as something that could be in some ways linked to donor reports and so forth. But the application guidance makes it clear that it is, at least within the scope of IMPAG, only applied as the IFRS for SME currently stated, i.e. to a set of financial statements as a whole, which by implication would mean that if something wanted to be done outside of that, then it wouldn't form part of INPAG. If, for example, there was a desire to translate just part of an income statement or something, then you might choose to use the similar sort of tools, but it wouldn't form directly part of INPAG. So the questions again are the TAG members happy with the scope included, and the guidance in particular on the items I just described.
Okay, thanks, Nigel. Any comments on either of those questions? Erin.
So could I just add to that? We haven't taken these proposals to the PAG as yet. We've had some input from a limited number of PAG members. This is an additional meeting that was put into the calendar, and so our next PAG meeting is not until next week. So we are going to be running some of these questions by the PAG next week as well. So just wanted to let you know that, particularly when we're looking at the scope of the guidance, we haven't had the full range of input as yet, but we would really like to hear TAG thoughts.
Thanks, Aaron. Yeah, Jeff.
Sorry, I have another question. So you're saying that this presentation currency concept is regardless of whether your functional currency, you run through the test and you determine your functional currency is currency X, but you voluntarily decide to present it in Y, currency Y. Is that exact? But you still have to follow all the translation rules as per INPAG or per IFRS for SMEs. Is that what you're getting at? Yeah.
No, exactly. So, I mean, that is permitted in full IFRS as well today, of course. But the distinction I was raising was that an MPO might want to say just present its income statement alone, and of course they can do that, but that would not fall within the scope of INPAG as currently drafted.
Right, that might fall into the special.
You have to do a full set of statements.
Mm-hmm. Right, and that might fall into what's the work being done on the special statement.
Exactly, exactly. Mm-hmm. That's the point, yeah.
Ian, you're on mute.
Yeah, maybe some, Nigel.
Okay, so moving on to the implementation guidance, which is the section that I spent most of my time on. So there were a number of examples included, and the paper sort of sets out the reasons for those. But essentially, they were attempting to look at the types of impacts that can happen on restricted funds and restricted income as exchange rates move, looking at both where donations or grants are received in advance and where they are received in arrears, and when rates moved favorably or adverse, which inevitably give a sort of a spread of outcomes. I think it was worth asking the question about the scope, because of course there's such an enormous scope of potential things that could be covered. So it's possible the scope here is missing other really important items that should be covered. Alternatively, maybe even the items here are in too much detail, because showing any guidance here does have certain risks and challenges, I guess. And then within the particular examples they chose, they did tease out, at least for me, a number or three particular I guess accounting points that I think views on would be very helpful. The first is that do TAG members agree that where some money has been received in advance, if on a restricted grant, if the exchange rate were then to change, should that item sitting on the balance sheet be retranslated? In other words, is it a monetary item or a non-monetary item? Where the money is received in arrears, it's clearer that it is a monetary item. Secondly, is the way that the items are presented and in what hits restricted versus non-restricted. And linking to that, I think, is the third one, which is if the deferred income, if you want to call it, refer to it here as the binding grant arrangement obligation, is retranslated, and then, or should the change, say it increases, be reflected as increased restricted income, or should it be reflected as increased unrestricted income, or potentially reflected as not as income at all?
Okay, thanks, Nigel. So any comments then? Jeff?
I spent a lot of time on reviewing these examples because I am working on the special statement working group, so I wanted to make sure I understood them. I thought the examples were really good and helpful in understanding the different scenarios that could happen. The one thing that confused me a bit, and I could sort of send you some comments, is if you translate whether the money, if the money is received up front or before, you know, the obligation's been fulfilled, then it seemed to me the example only worked if you converted the foreign currency immediately into local currency, and that wasn't clear. And then in other cases, obviously, if you haven't received the funds yet, there still would be denominated in the grantor's currency. And I thought you have great linkage to the grant agreement, but I thought there needed to be a bit more linkage to INPAG itself. So if it's, you know, obviously if something is denominated in the reporting currency, there's no translation necessary because you're already in the reporting currency. But if it's in the foreign currency still, then obviously you have these changes. And then the second point which you brought up is if you have excess where you have to incur additional expense because the exchange rate moved the wrong way, and that became, you had to use unrestricted funds to fulfill the restriction. I think that makes sense. That isn't in INPAG though. That isn't in the base guidance. It's only in the example. So that's something that might need to be added if that's what the TAG and PAG want to do. So that was my take on it. That or another argument could be it's all restricted because it's restricted for the purpose that it's been granted for, and now even though you've had to incur additional funds, I guess you still have to take them from the unrestricted. So I guess that needs to be in INPAG somewhere in my view. So those were my two takes on the examples.
Okay, thank you.
And I think that sort of tees up a future discussion that the TAG will have around that supplementary statement working group outputs, because the more that the INPAG can build in sector-specific requirements and options, the less options will be required within that supplementary statement. So that's going to be something that we'll come back to. And I think this is a particular area where you can see the opportunity for building the linkages. Bill.
Yes, thank you. No, I very much agree with what Jeff said. It was not clear to me how we got to the conclusion that these excesses or insufficiencies always went from restricted to unrestricted, but I agree with him. That's something that should be addressed somewhere in the guidance. One other general comment, you use the term overseas a lot. It should be foreign, not overseas. Mm-hmm. Overseas, I mean, you might be going for, so maybe in England, everything is overseas, but not in Mexico. And I went through the examples. I liked them as well. I struggled with some. I got through the first two. I didn't get further than that. I was working on them last night. I have lots of suggestions and comments, the way the columns add up. And I think there's several minor mistakes. The concept is very good, but I struggle with going back and forth from restricted to unrestricted, and some of the columns just didn't add up. So I'll send you comments on that. It's not worth going through them. I saw what you were trying to do. The last comment I had was, defined exchange rates. My goodness, is that common or is that not common? I found some. You said here's the contract, here's the exchange rate, the date it was entered into. Here's the exchange rate, the date it was settled. But there's another exchange rate which I didn't even know existed called the defined exchange rate in the grant agreement, and that complicated it quite a bit. And I wasn't sure how applicable that would ever be. Maybe it's very applicable, and I'm just not familiar. But I want to go through the rest of the examples, Nigel. I will do that and send you my comments. But thank you for the effort. It's very good. It's very helpful. But I think we need some work on that just now. Still, thank you.
Thanks, Bill. Very helpful.
Thanks. And yeah, appreciate your comments when you send me. That'd be great. Thanks.
Great. Okay, Karen, you want to come in?
Thanks, Ian. Yeah, it's great to hear your thoughts about the extent to which things are built into impact, particularly how we treat the gain or loss in terms of whether it's restricted or unrestricted. I must admit, I've been sort of playing around in my head a little bit about where does that sit? Does it sit in the revenue section? Does it sit in the expenses section? Does it sit in the foreign currency section? And I must admit, coming into this meeting, I put myself firmly on the fence and thought I'd like to see what conversation took place on this. But it would be useful, if not now, perhaps when you've had a chance to reflect on this, because I agree we do need to put this in the guidance. I was a bit concerned that it might be a bit lost in the foreign currency section, but it would mean otherwise building it into both revenue and expenses, because I think we have to look at it from both the grant recipient and the grant provider perspective. Phil has now added something in from the grant provider perspective, but maybe it's the revenue section where we need to do a bit more. I would really appreciate some thoughts on where actually you think it might be most impactful, because I think it definitely needs to be there. So thank you.
Thanks, Karen. That might be something where we ask some comments offline on that then. Okay, any other comments on the foreign currency translation section? Yeah, Chen Chan.
Thank you. Just one additional information I would like to share with you. Maybe it's not directly linked to section 30, but I think may be relevant. As you may be aware that currently ISB has another project that's called Lake of Exchangeability. And I think maybe those NGOs also operate in some jurisdiction, their currency are Lake of Exchangeability. And we're going to make amendment to IS 21 and to clarify what kind of situation and provide guidance to help entity to determine the exchange rate when the currency they are using a lack of exchangeability, and obviously all additional disclosure requirements as well. And we also develop several, I think, very useful examples to guide those entities. I'm not sure whether you would like to have a look, Nigel, and whether you will feel that will be helpful, or whether you would like to ask additional question when you issue exposure draft, whether those guidance should be included in your final guidance, something like that. I just want to update to you that we are going to finalize it very. I think the final amendment will be coming out very soon. Yeah, thank you.
Okay, no, that's and I wasn't aware of that, and that I think would be potentially could be very relevant.
Okay, so I think thanks very much, Nigel. Well done on your first outing. So with that, move over to Karen to take us through the other ED2 sections to take before.
Thanks very much, Ian, and I'll be pretty quick with this. We went through all of these papers at the last meeting, but there were some sections that we dwelt on a little more. One was the financial instruments section, which Phil referred to earlier, when the view of the tag was that we did not need to amend it to reflect grant prepayment assets and grant payment liabilities. So we have removed references to that, and I've provided some extracts to show the removal of that text. Otherwise, it remains as it was before. So that is the first part of it. The second part was around provisions and contingencies. We said that we would come back to the group as there was further drafting on the revenue section to see whether anything needed to be updated in the light of that further drafting. I think to date we haven't identified anything specifically for the core text. The area that we have identified for update is the illustrative examples that are in IFRS for SMEs. There's an example around warranties, which we think is less relevant for MPOs, so we're proposing to remove it, but instead include an example around onerous contracts. With the third area is on share-based.
I wonder, Karen, just before we get into that, if I can just check whether there are any comments on either financial instruments or provisions and contingencies.
Yeah.
Not seeing any hands raised, so I think we're fine on that.
Okay, great, thank you. The third area was on share-based payments, and we had a more extensive discussion last time, principally around things related to equity. And as a result of that, we decided not to proceed with the section on liabilities and equity and save that for ED3. On share-based payments, there were a number of views and questions about whether we needed this section, recognising that it was aimed principally at employment-related schemes where shares were part of remuneration. But the drafting of the section does go more broadly than that. So reflecting on the comments of the tag, we've taken an approach that keeps the section but significantly reduces it. So acknowledge that there is a very remote possibility that there are share-based payments, talks to the definitions that are in IFRS for SMEs, but directly refers and requires an MPO to follow section 26 of IFRS for SMEs should they have any share-based payments, but not to repeat it in IMPAG because of the view that the likelihood of it being needed is so remote as to make it kind of almost unnecessary. So that's the approach that's been adopted there, and it would be good to get thoughts about that approach.
Thanks, Karen. Yeah, Freddie, lead us off.
So on this one, I could not exactly recall why do we really need even such a succinct guidance and reference. And then I went to BC's, and it was not still, at least to me, immediately clear. And reflecting on the research we had at some point put in front of us here in Australia, that accounting standards setters are not making accounting standards less complex. I was thinking, like, even if you can save one page, is this opportunity to do that? And if there is a clear reason outside employee benefits why we need that, then is it clear enough stated in the basis for conclusions? Because I couldn't see it there. So I would be in a camp not to have it at all.
Okay. Comments from others? So Fred is proposing removal. Anybody else supporting removal then?
I could support removal.
Okay, thanks, Bill.
I support removal.
Yeah, I think it probably could be removed. I mean, even in those cases, and there are cases where there is share capital, the likelihood of there being share-based payments seems quite remote.
Okay. So I think you're getting the steer there, Karen, that you know, TAG is quite happy to remove this.
Fantastic, excellent, thank you. And then the final part on this paper is in relation to the basis for conclusions, which we didn't share last time, but kind of reflects the discussions that we had, and in particular the rationale for removing employee share-based payments. Well, now we'll update it to reflect share-based payments going completely, but also the amendments that were made to section 28 on employee benefits. The other question in here is about dealing with repetition, because all of these sections were put together because none of them were the prioritized topics for inclusion in the first IMPAG. And so they are all in the situation where they have not been fully reviewed. They have been updated for terminology and alignment with other sections. So the question is, do we want the basis for conclusions for each section to be self-standing, so that you can go to that section and see why there's not very much there, and or whether we address it in the preface by putting a more general point there. So if there's any views on either of those approaches, that would be very helpful too.
Thanks, Karen. Any comments on that? I think we're at the end of quite a heavy session. I mean, it just, you know, I wonder whether it isn't one of these ones where you need to do belts and braces, that you need something up front and then you need something chapter by chapter, depending on which way people get into it.
That's my inclination, is to do both, and clearly it's easier to edit things out than it is to add things in, so there's opportunity to revisit that once we can see the whole thing.
We broadly go with that.
Yeah,
makes sense. Okay, anything else then, Karen?
So if I can just sort of outline arrangements for the next meeting and also next steps in terms of closing out ED2. I'll do ED2 first. So based on the discussions from this meeting, our intention is to send out a full draft of ED2. We'll be aiming to do that by around the 10th of March. That's the date that I'm aiming for. And that will go to all TAG members to get comments back by the end of March, is the time frame that I'm looking to work to. We then have a meeting on the 9th of May. And we will use that meeting on the 9th of May to go through the key points that have been raised, that have emerged from the full draft that I've circulated. So this is sort of that kind of fatal flaw review. And we will do as we did last time, which is we will take up all of the comments that you have provided. We'll look to respond so people can see how we've dealt with comments, but try to float to the surface the things that are of most significance to enable us to close out ED2. We are looking to publish ED2 around the end of June, probably the 28th of June is the date that we are looking at. And to achieve that deadline, we have a cutoff on the 18th of May to hit that time scale from a publication point of view. So it is pretty tight time table to get us from where we are now to publication at the end of June. Feels like that's ages away, but it really isn't. So we're going to be really working quite hard to turn these around, and would really appreciate it if you could get your comments back by around the end of March to enable us to do the analysis and work through the issues that that have been raised as part of that. So that's the timetable for ED2. We will also be turning our attention to working on ED3 and the topics in that as well. And the June meeting will be very much focused on ED3. Before we get to that, we have a meeting on the 28th of March. The meeting on the 28th of March will focus mainly on the work that's being carried out by the Supplementary Statement Working Group. And Jeff declared earlier that he has been a member of this working group, as have members of the PAG and the Donor Reference Group. I think we have a country champion on it as well. So it's been a small group that have been working on this. And we need some time to go through and discuss the proposals that are coming out of that group. So the next meeting will probably be a much shorter meeting with that as the key topic. However, if we reflect on some of the discussion today and we feel that there's something we need to come back for in parallel with the review in terms of guidance, we'll do that as well. So we'll come back with the exact timings. You may have seen something go in and out of your calendar on that today, but that's because we've not yet quite finalised exactly how long we're going to need. But we're going to try and be a bit more friendly to those people who get up really early and a bit more friendly to those who are really late, and squeeze the time in the middle of that. I'm actually going to be on leave for the next meeting, and so we'll put arrangements in place for the management of the Zoom meeting. But you'll probably still see the meeting come from my calendar if we can get the technology to work for us on that. So expect to see some changes, but expect to get some diary time back from that. But the quid pro quo is the draft of ED2 coming out, which I suspect will take you a bit longer to go through than the time we're giving you back. Apologies for that, but want to try and give you as big a window as possible to look through. And so if you have got any comments, drafting or anything from the papers that went out today, it would be great if we could get those by the end of this week, to enable us to include that in any drafts that come out by the end of next week. Thank you. You're on mute, Ian.
Thanks very much, everyone, for today's meeting. We've covered a lot of ground. Thanks very much for the time preparing for it. And as Karen said, thanks very much in advance for the forthcoming review. I think thanks also to the staff team for a good batch of papers, which has really helped us to move through a lot of material very quickly. And I think with that, we are actually more or less on time. So well done, everyone, and look forward to seeing you again at the next meeting.
Thanks very much, everyone. Thank
you.
Bye.
Bye.
Bye. Bye. Thanks. Bye.
Thank you all.
Thank you.